Good evening to all. Today's webinar comes at a time where we start off the March series on a very bearish note. If you actually look at the market breadth today and the way the indices and most of the stocks have taken a beating in the intraday session, it was one of a kind. And we are staring at a point where today it's almost the 6th consecutive month from tomorrow if March begins, where month on month you have had a significant sell-off which continues to mount up as each day progresses. So really the questions which we want to address in today's webinar is, where is the possible bottom for the market? Where can we anticipate some kind of a respite or a recovery rally from the market, because things have been pretty rough in the last 5 months? And which are the possible sectors and stocks one can look forward to? And what is the best way one can strategize themselves in these challenging conditions? So I take forward my webinar here with the next part of my slide. So if you look at the February series, we have lost by around 700 odd points in just the month of February. And overall, it's around a 15% fall. That's around 3,700 plus points, which we have lost in the last 4 to 5 months. Now, this is more of a record-setting event. As I said, that 5 consecutive months of sell-off for Nifty index was last witnessed in 1996. Yes, 1996, and today almost in 2025 you have a similar phenomena happening. So this is one of it is not a regular event. It is happening in situations where there is some bearish news flow, but not of the kind where you are alarmed by the news like you had in COVID or the global turmoil which you had in 2008. So this is a different kind of market we are completely dealing with, a demon in itself, because the way the stocks are bleeding is some really big concern for most of us who are from the trading community. Now, one more key feature here is the India VIX, which surprisingly is around the 13-14% mark. So in the last 4-5 months of bleeding in the market, ideally, if we should have seen the VIX somewhere around 17-18% at least. So this clearly means that the markets have caught the investors on the wrong foot. Really, there has been no time to build any major hedge positions for this fall, because it has come all of a surprise. We are anticipating bounce month after month, and really the market continues to surprise us with month on month selling as it has been doing. So if you look at the rollovers for the March series too, 83% a March month from February, and most of them have been rolled over on subsequent shorting bets. So short positions in stocks and indices have been taken over at a rollover cost of 0.5 to 0.6 in the Nifty index. And the long short ratio, if you look at the FII data, the long short ratio for the past 3 months has been under 20. We always look at long short ratio as a contrarian indicator. Whenever it goes below 18-20%, we look at buying opportunities. But unfortunately, last 3 months, long short ratio has been around 17 odd percent. I'm talking about the percentage of longs in system, 17% longs, 83% shorts. That's the ratio we're looking at. This has been prevalent in the last month, and really things are not improving despite, as a contrarian, if you were to look at this ratio. Now, options data, 22,000 is an important support, where significant chunk of put writing has been placed. Now, really your VIX is not disturbing. So if you look at the way the option writers are moving in this market, yes, it's not been more of a pain point for them. The pain point has been for investors. The pain point has been for the retail guys who have been clinging on to the stocks with hopes of a recovery. So it's not much for option traders, but the cash traders who are facing the heat in the current market scenario. So what are the levels we are looking at in the current market scenario? I will take you through the roadmap. So today, as we close the day roughly around 22,150 odd levels, this is probably the last leg of pain point, which should subside soon. This is the view which we hold in the current market scenario. Now, there is a massive support zone based on the technical price setup, which is seen at the levels of 21,800. Whenever you have seen the market fall when there was no apparent big news at stake, We have seen corrections up to 15% or 20% from the tops, and here we are almost around 15 odd percent. So I believe 3-4% plus minus 2-3% plus minus, not more than that, is the pain point. So roughly around 21,800, 21,900 is the sweet spot for the market, where our expectation is that there can be a respite rally. So are we looking at a V-shaped recovery? The answer is no. The market might take some more time to spend once we are near the support. It completely depends how the data plays out once we near the support, and we will keep you updated via our WhatsApp, our emails on the same. So 21,800, 21,900 is the zone which you need to keep strongly in mind for the March series. Because these are opportunities. These are opportunities which come once in many years. And although most of us have been bleeding, it is time to take that additional risk and go for the kill, because really after 6 months of downside, this can be really rewarding if you get it right. And the risk reward from the current levels is absolutely beneficial. Now, if you look at the typical seasonality of the March month, it's more of a mixed bag. But the silver lining here is, whenever traditionally we have seen a negative February expiry or a negative month for February, the March has always rewarded the investors with a positive close. So that's more of a historical trend which the March series depicts. Otherwise, Bank Nifty 2 has more of a short rollover scene with 82% kind of a short rolls compared to the 77% historical 3-month averages. Moving on is a bottom in place for the market. So as I said that individually stocks have corrected almost by 30-40% from their peaks. If you look at the FII holdings, now if you look at this table here, I've just highlighted the action of the FIIs in the equity, debt, derivatives and the mutual funds. Total here is for the last 6 months, and clearly it's a sea of red as I see on the screen. There have been significant selling numbers, and really we really have a question as to when will this end, because really FIIs have been pulling out the money strongly from the most of the emerging markets, and really to get them back to the Indian market, it is going to be a Herculean effort. Your rupee dollar also is not supporting the scene with 87 rupee dollar, just keeps on depreciating by the day. That also is adding to the worries, along with the measures taken by President Trump on the tariff, which has been hurting the market sentiments. Now, technically, there is a hope. As I see, RSI is one of the most common indicators which many of us have been tracking, and a common phenomena which has been seen is that whenever we have an oversold scenario with RSI going below the levels of 25, this has happened only 5 times, mind you, in the last 10 years. We have seen the markets rebounding back after this phenomena is noted. So we are going with the historical evidence. If the RSI and the levels and the options open interest at 22,000, all these 3 things have been considered, have been taken into consideration, I think 21,800 is the sweet spot, which is where the market should ideally be bouncing for. It is also a 500 DMA and a 200 weighted moving average support. So a lot of confluence at this support zone, and I think that's the area which we should be keenly looking forward to. Now, sector specific, what's in? If we're talking about a bounce back, that's probably, with today's closing, we are almost near the levels, maybe 150-200 points away. But what is the sector you need to be looking at? Clearly, it is the financial services space we would be gung-ho on if we are looking at a recovery in the market, because technically the price structure is pretty strong. It has primarily been supported by the private space in the banking, because if you look at the weight constituents of the financial services space, Axis Bank, ICICI Bank, HDFC Bank make a big chunk of weightage of this particular sector, which has been designed by the NAC. And looking at the price setups of majority of these components, I think financial services space is the space one can look forward to target that short-term bounce back or the respite recovery rally if we are looking forward in the Nifty from the 21,800 zone. Now, how are the FII positioned? As I mentioned at the beginning of the March series, if I were to see percentage-wise, last 3 months have been on an average around 17-18 odd percent. This time also we start with 17% long-short ratio, 17% longs. It means very poor positioning on the long side by the FIIs in the index futures. Cash segment gets worse. There are no buying intent from the FIIs there. So really the numbers are not good, not shaping up well, but really from a contrarian perspective, with so much shorts in the system since the last 3-4 months, it does make a condition that there can be a surprise element in the market which may be just round the corner. So keep a watch, close watch. 21,800 zone is the zone you need to be looking at. In case of recovery, 23,800 is the recovery zone or the target area. Initially, we are going to take this step by step, not going for massive targets, but right now 23,800 is the best we look at from a bounce back theory if we are looking at a recovery in the Nifty from the current levels. Some of the news flow you should be carefully tracking in this month will be the FII flows, how the NAV propping, because March is traditionally a month where in the second half of March, all these mutual fund schemes and they go on the NAV propping, which sometimes is a positive sentimental factor for your schemes and stocks. And tax loss harvesting also is one of the factors, because a lot of loss has been accumulated in the books of many investors. So they are likely to book out their losses in this current financial year and buy back the stocks at lower levels so that they make the gains on their taxation part. At least they can write off that losses in this particular year against the capital gains they have. So I think tax loss harvesting is one factor you can look at, which can kind of bode well for the markets in the second half of March. US Fed meet on 19th of March. Geopolitical and global news as they play out would be the another things you need to be carefully glued onto for the month of March. Now, lastly, one small strategy I would recommend, because strategy is a bonus which we always recommend to our viewers, those who are inclined on the derivative side. If we are playing with the view that 21,800 is a massive support, one safe strategy I may say using the options is that you sell 2 lots of 21,700 put and you buy one lot. There's a typo error here in this, but you have to buy one lot at 21,800 put, and the whole logic is that you are devising a bear put spread along with selling of an additional put, and this is for the monthly expiry. So this strategy is called a ratio put spread, and this strategy covers you all the way down till 21,300, which is almost 1,000 points from where we are trading today. So that's a good margin offer which you get on the lower end for the entire month. The probability of the bounce back is very high from where we are, maybe 200-300 points plus minus, but really this strategy is one of the to-go strategy for the month of March. It works well for you in 3 different situations. Even if we close sideways or flat, the market sticks to 21,600, 21,800 zone, still you make up the inflows which you get of around 5,000 plus in the strategy, as you're selling 2 puts against buying 1 put of 21,800. So inflow is guaranteed. If it goes up again, you are making profit, and even if it goes down temporarily, you are able to kind of mitigate the volatile situation because you have already a bear put in place. Although the additional put sell might get you an M2M loss, but this strategy plays out well in volatile situations where you anticipate that a dip is for sure. So the best part here is you can target around 7,800 monetary profit. You can keep a loss or a risk stop loss 4,700 if it's monetary based, or a level based stop loss of 21,400. So all in all, to conclude that it's been challenging times, and really the best way to approach here is to put more additional funds. You cannot be on the bench and have a wait and watch approach, because opportunities, as I see it right now, come very few. You have to put more funds at the current level in stocks, and if the stock market bounces, it has to be the Nifty 50 blue chip companies which will be reacting the very first. So have your stocks shortlisted, have a clear game plan, stick to the levels which we have mentioned, and I believe the roadmap for the month of March should pay well and should give you a good respite recovery in your portfolio from the challenging times we are in. So would like to conclude my part and open for questions and feedbacks on this session. Thank you.
What are the main points to look for trading in stock option? Is PCR theory applicable in trading stock option?
See, the OIPCR theory is very widely followed theory. It's just that when you're trading stock options based on OIPCR, you need to have a specialized trading software like a Bloomberg, because really OIPCR is where you divide your total open interest puts divided by open interest calls, and you get a ratio. Now, ideally, the whole thought process is if the ratio is below 1, it means there are more call writers. If it goes above 1, there are more put writers. And as a PCR theory, as a contrarian indicator, what we look at is the extreme band where the call writers become so heavy in the system that you are looking for a turnaround or looking at buying from a highly oversold zone and vice versa. So really, what is the sweet spot for such a turnaround? It's a difficult take because special expert softwares, like a Bloomberg, can help you out based on historical data. For Nifty, we have this data that whenever the OIPCR gets below 0.6 for the week, for the monthly one, and probably 0.4 for the weekly one, you can look for turnaround or reversal opportunities. Vice versa, when the OIPCR moves above 1.5, you can look to short sell the market. For stocks, it's a different ball game, but you can go by the simple rule that whenever the OIPCR goes below 0.9, you need to be a bit alert because call writers are kind of piling up on the call writing front. If it crosses 1.10, it means the market is getting into a safe zone. Put writers are getting into the system. This just draws you comfort that how the positioning is placed in the stock option segment.
How to choose between Strangle versus hedge futures trading strategies?
See, short strangle is one of the most popular strategy where you sell both calls and puts with an estimation that the stock will remain in the price which you define. It is a no-brainer actually. You will be very surprised to know because it's very easy to set such strategies because the range you get, you can set the range as per your comfort because normally, the range which you define is not something which the market would normally move, but such strategies are strategies which can be unlimited loss strategies if you get it wrong. So repair risk management is the key whenever you set the short strangle strategy. You need to be very sure that the market will be range bound. Have your game plan in advance. So the thought is which I have is if you go for short strangles, avoid short strangles but go for an iron condor here. It is just a revision of short strangles where when you sell calls and puts, you're also buying deep OTM calls and puts. You're buying the deep OTM options just to safeguard yourself against any untoward price moves either way. So my preference is that if you are a newbie, you are exploring the options market strategies, then the iron condor is best suited over the traditional short strangle strategy. And as regards the futures market here, when you talk about hedging futures, the only way you can look forward to hedging your futures, if it's index futures, you have to go for buying puts. But again, buying puts has to be done when you are very sure on the momentum of the market going down, because both buying puts and futures can lead to losses if not timed properly. For stocks, yes, I think selling calls is the better preferred way of hedging. Although it costs you more, it requires more margin, but that's more of a safer bet here. But again, buying puts to safeguard your portfolio would work if you are right on the timing front. Timing is when you buy it and the stock should ideally fall. And ideally, I think if that is the case, you would be better off selling the stock and buying it at a lower level than using puts as a hedge mechanism. So I would prefer selling calls whenever you have an exposure in futures, although it might give you a limited a cover, but that is a safer and a higher probable way to approach hedging. You can also use shorting futures against the cash you have. That is one of the traditional ways, but then again, you have to be damn sure about the markets at least tanking from the levels you short. So these are the two things, but more of timing-based strategies. I think shorting calls is the way to go.
With FIIs aggressively pulling out capital and Nifty experiencing a sharp decline, how do you see the interplay between institutional option writing and retail speculative positioning influencing market volatility ahead of expiry?
So, expiry game now has cooled down completely because there were days when weeklies were pretty much available for of the indices. You had Nifty, you had a time when you had weekly Bank Nifty, and it came to a point where the retail was somewhere burning cash, somewhere was at the receiving end of options trading, because SEBI, as it says, that 90% or more of people have been on the losing end, and that's the truth behind it, because most of the retail traders are buyers in options, and really, buying options is all about timing. You need to have those skill set, then only you are apt to trade this market, otherwise you will end on the losing front. So really, I think now the weekly contracts in most of the indices are done and dusted. It's only Nifty which is available for the weekly contract. Sensex is available. The rest have all become monthly. So with limited weekly contracts, I think the FIIs too have cut down their exposure now in the weekly trading. There are times when your high frequency, as you call the HIT kind of trading, does occasionally, raffle the market, but the instances have become few now. And with SEBI kind of safeguarding and tightening the screws for weekly expiries, it's become more of a safer game than what it was before in terms of the price volatility. So I think weekly is a good way to approach, but again, you need those skill sets to have before you approach that particular financial instrument. So if you are apt at timing the market, you have the necessary technical skills and the proper understanding of how the Greeks play out in options, I think weekly would be best suited for.
What are the steps I should take before starting derivative trade?
Well, the basic step is, derivatives is a leverage market. And when we talk about leverage, we are talking about exposure, which is minimum 4 or 5x of what our capacity is. So we are playing beyond our capacity. That is the first thing we need to register. So derivatives trader, developing patience is the key. Having apt margins at your disposal is the key. It is not for the faint-hearted, especially in the markets we have been. If you have been the wrong side of the market, derivatives market can kind of be really cruel on you if you get it wrong. It can be absolutely rewarding if you are good at timing stocks, buying and you have sound knowledge of technical analysis to cope to along with the derivatives piece of data which comes. So again, I would say derivatives market requires a lot of patience. If you are kind of there for short gains, where you are only interested in kind of scalping the market, I believe you need to kind of first paper trade and get your ground plan ready, because this is not the market for faint-hearted. You really have to have a game plan before you enter the derivatives segment. I would say whenever you buy futures or you short futures, then it is absolutely essential that you have a hedge position in place when you create the trade. For example, suppose you are bullish on Reliance. You are buying Reliance today at let's say 1800 odd levels. Immediately you have to counter this by buying a put at the same time, because if you are getting this wrong, then at least that put is going to safeguard you against that minimal 0.5-1% fall, and it's not going to create that panic situation for you as to what to do next, where markets would likely take off your short-term stop losses and then see a reversal back to your buying price. We do not want such situations. Trading should be a smooth experience. Ideal stop losses and targets which you set for before you take the trade should work. So use options to hedge your futures positions, and that's the first baby step to start with when you trade derivatives. So thank you all.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.